Today we're gonna react to a clip of Jim Cramer that he made towards Cathie Wood. He was analyzing her trades, talking about what her strategy is, and really talking a bit negative about how she's trading and whether it's a good one or not. And we're gonna have a look at it. I'm gonna react to the clip because I have a few thoughts of, where he's kind of right, but where is he also wrong, and where I'm more leaning towards Cathie's strategy. But really, in the end, it's up to the investor to decide. So let's get into it. But if you haven't subscribed yet, please hit the like button and subscribe to the channel. But let's go to the video. Let's start, and I will just react to whatever he says.
Market action, Jim Cramer. Jim, it's always great to get your thoughts. What did you make of a day like today?
Well, today obviously just a terrible day. The juxtaposition of
So this is on the 18th of February, just by the way. So this is quite a while ago. We had the market coming down with, the war didn't even break out yet. That was just based on the interest rate fears and everything else. But stocks like ARKK ETF, ARKK, that one has really hit hard and was already down like 40-50% from their all-time highs. And so we have a look at that right now. As you can see here, the stock was already down back then. So this was on the 18th of February. Was pretty much at the levels that they are at the moment, so around the $60, a little bit lower than that. Yeah, 65. So actually exactly the level that is right now, which is in the past 6 months, 44 drawdown. In 1 year, it's 47%, and in 5 years, still up quite a lot. And that's what we're going to talk about as well.
Cathie Wood on Scott's show with what happened today and what will happen with Roku, the CEO, all very painful. I think it's painful because there's a lot of new people who come in, and you and I have been around this, and we know that people tended to buy these very exciting stories. They bought excitement, they bought price to sales, they bought stories that sounded like you couldn't, you had the future. And there you had Cathie Wood, and you heard this, Sarah.
So what he's talking about is obviously that if you're a new investors and you see the world of the stock market and you see all the different companies, you're more likely to invest in something like a Roku, a Teladoc, a HIMS, a Voyager, like something that has a big growth story behind it, and it's kind of exciting to be a part of, where you think you can 10x your money in the future because that has so much potential for the future going forward, than something like a Coca-Cola or like an oil company or electricity company or something like that, where there's just not much happening. There's not many news out there. It's just not exciting enough for the newer investors. So this is what he's talking about. And obviously those types of people would then tend more towards an ETF or fund like the ARK fund, where it's all about innovation, all about exciting companies.
Giving you a view which just basically says near-term price doesn't matter, but we have people who are terminal value buyers who can't have that staying power. Yes, when you go to play blackjack at the casino, it's 51.49 if you can hang on long enough, but most people can't. And what we're seeing are people who are being blown out even as she's soothing, and I found it very disturbing.
ARK Investment, or Cathie Wood, she has that strategy of saying have at least a 5-year time horizon for your stock to play out, and on that 5 year, on average, she's trying to achieve a above, I think, 25% annual return rate. So if you look at the actual stock, we looked at it 6 months. If you look at it just now, we would be like, oh my god, what is this? I would never invest in this. If you're a new investor and you don't know anything about it, it just looks like a horrible investment. 44% down on the year as well, 47% down. But then when you actually zoom out to her 5-year strategy, you can see that as of now, the strategy has worked, because obviously, that 184% drawdown going up over the few years is like an annual compounded growth rate of almost 37%, which is obviously outstanding. If you would have invested all this time here consistently into the fund, even after that 40 or almost 50% drawdown over the last year, you would still look at an annual compound growth rate of 37%. And at their peak, obviously, this stock was up, or this fund was up 576%, so significantly higher, but still her growth strategy works until now.
Should we judge, Jim, should we judge her now? I mean, her highs in her ETF was February. Is the time frame too short? I understand your point. I understand that a lot of people have lost a lot of hard-earned money. But is our time frame just too short to?
So that's one statement as well that we need to correct here, because obviously what they're saying is we have these new investors and they invest into a fund like ARK, and then they see this drawdown happening. They see, oh my God, it's just going down and down and down. I lose my money, my hard-earned money, as she said, and then they sell. And what they've just done is once they sold, that's when they actually lost money. If you just leave it in here and you just leave it for a few next years, you haven't really lost anything until you realize that loss. And as we just said, if you actually zoom out, you haven't lost that much overall. If you look at it from an annual perspective, you actually outperformed the market massively.
You know, a bet on innovation.
I've been talking to many managers about that, and all of them said the same thing, which is that if it were a traditional fund, all of the money would have been pulled out because people can't afford to lose that amount. Look, I think that innovation is a terrific thing.
So what he's saying is, if you usually invest into an ETF, right, you're doing that to kind of get a market or above market return. So you're trying to give your money into the hands of someone else. You're paying a fee for that, and they manage a portfolio which you evenly invest in, and they're trying to either be in line with market if you have an index fund, for instance, or you're trying to be above the market. And what he's saying here basically is that, if you're trying to be in line with the market, and usually you would have a fund that needs to follow that performance. So ARK is basically going completely against this whole market indicator, market benchmarking against the S&P 500 or something like that. They're just looking at actual companies, buying them and holding them for the most part, and then basically outperforming by picking a few big winners. Like in that basket of futuristic innovative companies, there will be a few winners, and those will then cause for the high performance of the fund, like Tesla did for ARK a few years back now. So that's the difference what he's saying, because usually what's the target of the fund is that you limit your downside risk, the limited amount of money that you lose, and you kind of be in line or slightly above market returns.
I think that the way it should work is you should have research people, and by the way, I thought it was a great question by Scott as they went fire. You should have research people who are doing technology, and then it is given to people who do securities analysis, and then it's given to a trader who tries to figure out what's the correct price. This fund, she has just clearly skipped step 2 and 3, and
So usually when you have this fund, that's what he says. Basically, you would have someone who researches the company itself, then they would look at the fundamentals, and then they would look at the graphs and see when to enter those trades. But what he's describing here is just it's almost like a, what the market is doing, like a momentum analysis, like what is hot at the moment, where can I put in my money right now to make a gain over the next 6 or 12 months, basically. That's what he's saying in the last bit of that, where he's looking at, is it from a trading momentum? Is that the right moment to buy? I do think she does step 2. She does a fundamental analysis, and based on her analysis and their business case, the stock is a deal at that moment. So she buys on the days when it's drawdown significantly, like 5 or 10% drawdown of those high innovation, high flying stocks. That's when she heavily buys, and that's what he is criticizing here at the moment.
I like what Josh Brown said, and I have great respect for her. But the fact, and I would never do this short, but the fact is that she's more emblematic of the moment. And we had people who were emblematic of the moment in 2000, and they are, and I was just telling Sarah during the break, true believers. And true believers are terrific. But Melissa, the problem is that, as one of our guests said earlier, there are no bids for the true believers. The only real buyer of some of this merchandise is Cathie Wood. You cannot create a market yourself. Nobody's that big.
So he basically, again, he's talking from a momentum trading perspective rather than from a long-term investor's perspective. Because obviously we know that the stock or the ETF fund had, with all the stocks inside, had like huge drawdowns over the past year because of what the names are in there. They're all high growth, innovative stocks. There's no hedge. There's no bet that is, works against those innovation stocks. Because if you look at the top 10 holdings, we've got Tesla, Teladoc, Roku, Zoom, Coinbase, Square, Exact Science, Unity, Twilio, UiPath. They're all high growth futuristic companies. Like only one Tesla, Zoom, they're making money, Square, but there's a lot of others that are not yet profitable, not yet making money. They're like high growth, high potential. They have high revenue growth and high gross margins, but their net income is more like in the future. So that's why there's no hedge here. So if it draws down, everything, like the whole fund falls down. That's why we see such significant drops, which is unusual for an ETF. This is just because of the way this is built. It's just purely innovation stocks, no hedging, nothing.
I do when I see her buying things. I am shocked at what she buys and how she buys.
That's what he explains.
She buys like someone who just started yesterday.
Well,
because she is just buying the dip, basically. So she looks at the stocks. If they're dropping, she buys more. If they're further dropping, she buys more. She sells other things to buy even more, to be even more concentrated in the top 10. So this is what she's doing. And he's basically saying she buys like a 5-year-old that just entered the market because she's purely just buying the dip without any, precautions of, well, is there more downside to come? Will we losing even more money? And he's basically calling out how irresponsible
So
that
I
is.
think the structure of it, she's an ETF, she has to stay fully invested, she has to keep buying. I mean, the conviction, I think, is what you're talking about. So would you touch any of these ARK names?
I actually so let's distinguish. I actually like some of these companies. I dislike the way they report.
So he's saying that, and I think it's true as well. Like I have a lot of those in my portfolio as well. He likes some of those companies. They're not just some futuristic concept companies with no revenue. All of them have revenue. All of them have good gross margins. All of them have massive growth ahead. It's just a question whether they can establish themselves as the market leader going forward and whether they actually become profitable in the long run for some of them. And that's the question here. So he actually acknowledges that, he likes a lot of those companies.
I really hate something called hubris. Hubris is horrendous, okay? Humility is important. When I screw up on something, like when I screwed up on PayPal, I own it, I wear it, I'm furious at myself, but I screwed up. I would never in a million years tell you, but you just wait, Sarah, because when that thing comes back, who the hell has the right to say that?
Well, and she also said the market is getting it completely wrong.
Well, there is no such thing as the market being completely wrong. The market is an assemblage of tremendous minds getting together, and you may think they're weighing machine, voting machine. That's all nonsense. The market is about trying to minimize losses and make as much money as possible.
But that applies to people who have already millions of dollars, and you give your money, let's say you have $10 million, $50 million, you give your money to those hedge fund managers. They're trying to hedge you, they're trying to lose you as little as possible money, and while still making market-like or above market returns. And this is what they're trying to do. That's why they're getting in and out of stuff all the time. That's why they're saying, well, now we need to get out of high growth stocks. That's why we had this huge drawdown. All the big money was pulled out. Now we're going to pull it into financials because the interest rates are going up. Or we're putting it into oil stocks because the oil price is going to go up. So now this is what they're doing. They're consistently moving stuff around. So this is what Jim is saying. He's looking at it from a like Wall Street trader perspective, hedge fund perspective, basically saying that you can't play around with people's money. You need to have that risk reward ratio. You need to always minimize the risk, minimize the losses while still making returns. Whereas there's a fundamental difference here between Cathie Wood, that she's just looking at it from an innovation perspective. They're saying some of these companies will be the market leader and they will be, they will triple to 10x in value because of the huge market that they address in future. This is what he's calling out, that you can see the difference of thinking here. He's thinking a little bit more like okay, you manage 100 million. What are you doing to protect the downside risk? And he's just basically criticizing Cathie Wood that she's not doing that. And I mean, it's fair enough because it's actually true in my opinion. But then if you are invested in something like a Cathie Wood, you have to be aware of that. You have to know that her type of fund, if you look at the top 10 holdings, you expect them to be highly volatile. You expect them to be, have almost unlimited downside risk. Like basically they can fluctuate all the time. They can lose, as we've seen. They've all lost, like almost all of them lost over 70% of their values from their all-time highs. So you have to just be ready and be happy with that when you invest in something like Cathie Wood.
What the market is. And if you don't think that minimized losses means anything, then you should just be running your own money and nobody else's.
So yeah, exactly. So he's basically saying, he is looking at it from a hedging perspective, from a hedge fund perspective, where you already have a lot of money and you're trying to protect the downside. But what is people doing, like for instance, like us retail investors? We're trying to, with comparable little money, with maybe 10,000, 50,000, 100,000, we're trying with that money, we're trying to 10x that money to become millionaires, to become wealthier. So this is why younger people and people that are kind of newer to the market are going for this type of strategy. The only thing is here is the psychological point of view. So I mean, you from a psychological perspective, you have to be ready to see high fluctuations on a daily and monthly basis, to only see in the future, like in a 5-year span, to see your fund outperforming. So I guess it's all about the psychological perspective, and of course also about your investment goal perspective. If you have already 100 million, why would you need to go high risk, high uncertainty into an ARK fund when you can rather spread your portfolio out in a lot of good companies and a few index funds, and just let it run, let it compound at an 8 to 9% market return rate, which is not bad at all. You don't have to go high risk. This is the type of fund, this is the type of investment for younger people that have a lot of time in the market, that potentially can vastly outperform the market over the long term, and then generate wealth by doing that. So that's why I'm still for ARK investment. I'm not invested in ARK fund itself, but I have picked a lot of these names. I've invested in Teladoc, Zoom, Coinbase, Square, and so on. So Twilio as well. So I have picked a lot of her top 10 investments, and I'm happy with the fluctuation because I expect that from a stock like this. It's obvious because the market, yet as he's saying, the market is right. The market is right in that moment. So in that moment, the market decided growth stock are worth not what they used to be, and they should be sold off. And then they start selling off. And then in that moment, he's saying, well, the market has voted. But over the long run, they might as well come back into it. And you don't have to get in and out of stocks all the time to be, in line with the market opinion. You can be against the market opinion, and I think that's where most upside potential lies. If you're an investor right now in those stocks, while the whole market is against you, you are likely to outperform the market when it U-turns. So yeah, that's all I wanted to discuss today. Let me know what you think about Jim Cramer, what you think about Cathie Wood. Are you invested into ARK Fund or into any of those? Let me know in the comments, and see you next time.